Manish Sonthalia as well joins in from Motilal Oswal AMC-PMS to talk about his thoughts on the markets. Manish, hi, morning. Would you be alarmed by the fifth consecutive session of a red tick for the markets and last 2 days of FII selling as well?
I think FII allocation has not yet started trickling in as far as Indian markets are concerned. The selling figure which we are seeing is more on account of arbitrage positions. So, in the run-up to the tapering, markets were expected to be somewhat wobbly, and we are seeing a bit of that. I don't think you'll see too much of a correction. My sense is maybe another 100, 150 points on the Nifty, and that would be it. So, yeah, we are seeing the fifth consecutive day of losses, but I don't think it's a case of getting alarmed about the fall. I think it's just a correction.
Manish, but some would argue that markets in the last 10 or 15 days of December 2013, they rallied very hard. They rallied only because of global liquidity, and there are no triggers in the system.
Yeah, December actually the markets rallied very hard, so there was a case for a pause, and markets are seeing a bit of a correction. I think the only hitch is if the FI flows don't continue and you have a tightening of liquidity in India, and that could be a case when markets could take a bigger correction, because you're looking at disinvestments, that amount of money going out of the system, government cutting down on expenditures, which means that sort of money is not going to flow back into the system. So I think the bigger worry is liquidity, and typically the fourth quarter you are looking at a case of a tighter liquidity. So I think this whole impact of tapering and how the FIs are going to react to it needs to play out. It's a bit early to call, but talking to people, I don't really see that FIs would remain very negative on India and other emerging markets, at least for the next 1 year.
In the near term though, Manish, what's the sense that you're getting about the earnings season? Could there be negative surprises, or for that matter, dark horses, or is it all just priced in?
There's no case of any big negative or positive surprises. I think the first set of numbers is coming out of the technology pack. Within the technology pack, it would be your hedges which could provide some sort of positive or negative surprises. What hedging policies companies have adopted and what sort of an impact you see on the profit and loss accounts are going to determine how the stock prices are going to react post the numbers. I think in the case of banks, and particularly in the case of private sector banks, it is credit costs which could provide some sort of a negative surprise, and in any case the better ones, of the likes of HDFC Bank, etc., are going to see some moderation in earnings growth, building in something like a 25% earnings growth instead of a 30% earnings growth, or something like an Axis Bank should be looking at 12-13% sort of an earnings growth. But what sort of a credit costs are going to get built in private sector banks is something we need to watch out for, because credit costs are definitely going to move up in the case of private sector banks. And in the case of public sector banks, incrementally the provisioning could in fact come down. So that could provide some sort of a positive surprise in the case of public sector banks.
So Manish, let's divide the market setup. IT is unlikely to surprise us because of strength in rupee. Banks, the outlook is dim. Autos are not growing. There is no evidence of economic bottom, any kind of economic bottom for cyclicals. Metals are still struggling, and FMCG is expensive, and FMCG is degrowing. So are we in for a big disappointment this time? I don't see a ray of hope at all. And markets are running up as if a new, dawn has started for Indian economy.
No, I think if you look at the earnings season this quarter, the base of last year was quite low. So in case of technology, even though everything seems to be priced in, you're looking at a 30% earnings growth. In the case of, let's say, healthcare, it would be another 18-20% growth. In the case of FMCG, it would be another 15% growth. In the case of autos, in spite of numbers not being there, and sequentially things might be just about what it was in the previous quarter, but on a YOY basis, things would look quite good. So, on an aggregate basis, we are looking at a 10 to 12% sort of an earnings growth. So, things are, and when you compare earnings, it's more on a YOY basis rather than a Q-on-Q basis. So, incrementally, things are looking okay. It's not a runaway rally. There will be hiccups along the way, but one needs to be more constructive rather than seeing the glass half empty. I would tend to think that the glass looks more half full.
Manish, let's talk about Infosys, considering that's going to be the one which is going to officially kickstart the earnings season. It's lost almost 4-5% in just the last 2 trading sessions. Do you think this time around the market is going to focus more on the recent organizational changes in senior management exits that have taken place? What could be the key thing that could make the markets happy from the management commentary this time?
I think a whole lot of issues need to be discussed as far as management commentary coming out of Infosys. Definitely the attrition at the top level management is something which needs to be addressed as to what is actually happening out there. More than that, it would be your IT budgets of companies and how Infosys is placing itself in terms of deal wins and what sort of business are they more focused on, whether it is the ADM part of the business, the more bread and butter part of the business, or whether it is the more value-added consulting, discretionary spending related businesses that they are going after. One thing is for sure that costs would have got contained thanks to Mr. Murthy's coming in, and you will see a positive impact on margins, but remember that they have just not upped their guidance per se. If you look at Infosys' sequential guidance, it is more of a degrowth, and they have really not changed that. And obviously, the market expects that the guidance will be bettered, or they will in fact beat their guidance. So, how much of a guidance beat do they come in, do they actually see? So, I think we are working with 1.2% constant currency growth and around 50 bips of cross-currency gains. So we're looking at dollar revenue growth of 1.7 odd percent, translating into a 5.5% sequential growth in net profits. So I think it's about IT budgets, it's about the product, the mix of business, it's about the HR issues, in terms of deal pipelines, etc. So and more important than that, what should be the hedges? I mean, they don't really tinker too much with the hedging policy. So in the case of Infosys, it won't be too much of a negative surprise. But these are the usual things that one would focus on as far as Infosys is concerned.
Manish, as a fund manager, somewhere are you tempted to look at FT or MCX?
No. I think we are done with that stock, and we're not looking at it.
So why were you smiling when I asked you this question?
No, actually, we have had to take some losses in this whole NSCL scam broke out. We had financial technologies in our portfolio. So, the way the entire episode has played out, I don't think we'll ever look at these stocks again.
So for the moment, how exactly are you positioning your portfolio? Last time when I interacted with you, you'd indicated that you were ready to buy into cyclicals, you were okay to give quality or some consumer names a skip. Has that thought process gained some more momentum? Are you now buying into cyclicals? Are you moving out of quality stroke some consumer names you want?
No, I think the thought process remains, but we have not really made too many changes. Except for the fact that now that we are into the result season, we want to actually see the numbers before taking a call. But the hypothesis about the entire PSU banking space bottoming out sometime in the third quarter, as far as the NPA side is concerned, that argument remains, and that presents a very good opportunity. Or to look at some of the media companies, that also looks quite good. So we'll take some bit of decisions here and there as the result season plays out, but as of now we have not really made any changes.
What are your top 3 holdings in the mid-cap fund you manage?
It continues to remain as Page, it continues to be an Eicher Motors, it continues to be a Glaxo Consumer. I think these would be the top three holdings.
To own Eicher, Page and Glaxo Consumer for next 2 years, because the run-up in all these three names has been quite extraordinary. Page has gone from 700 to 4,000, Eicher has moved from 800 to 4,000, and ditto when it comes to Glaxo Consumer.
Yeah, but earnings growth is coming, Nikunj. The whole argument is that if earnings are going to double in the next 2 years for a Page or an Eicher, it does make sense to hold on to these names. Because 2-year forward earnings, you are buying it quite reasonable. It's about 20 times for a Page and it's about 15 times for an Eicher, which for a Page is a 60% ROE company. For an Eicher, it is a good 25% plus ROE company. So you're looking at doubling of profits, and in case of Glaxo Consumer, you're looking at a healthy 20% profit growth for many years to come. I mean, just not for the next 2 years, but maybe for the next 5 years.
What are the other names that you like from the pharma pack, Manish, considering they are the only ones which are scaling new highs every day?
Yeah, this entire space is quite interesting, so a lot of mid-cap names are flying around here and there, and a lot of merger and acquisition deeds in the pipeline. Whole lot of names are there, but I think we continue to like an IPCA. I think we have it in our portfolio. I think the US business is going to gain traction from almost a zero turnover to a $100 million turnover in the next 5 years. This entire US setup, which was not there, is now kicking in for IPCA. The tender business is perfectly fine. It's doing perfectly fine, and domestic business, after a lackluster second half, is gaining traction in the third quarter. So I understand that AIOCD data suggests that October, November have been quite good for the domestic market. So within the mid-cap space, we continue to like IPCA. I think within the CRAM space, DVS is a pick for us as far as the large cap is concerned.
Manish, we've seen a big trending move in mid-caps. How does one judge that what is the way forward for mid-caps, and this excitement in mid-cap will not end in some kind of a disappointment?
Nikunj, in 2012, mid-caps outperformed the large caps. In 2013, you have an outperformance of the large caps over the mid-caps by more than 10%, 13% to be precise. And in the case of valuation difference, large caps are still expensive over mid-caps to the extent of 20%. What we are seeing currently is the valuation gap getting compressed. And if you're looking at something beaten down, what it should be, the valuation gap will be there, but if it is beaten down below the historic averages, historic difference what you have, there will be a reversion, and that is what we are seeing. So it is more of a bottom-up approach in the case of mid-caps, being sector agnostic. Wherever you find value and the growth, those are interesting plays. So I think 2014 is going to be a year for the mid-caps. Large caps will play catch-up only after some time. So there's still some time to go on that front. But 2014 should be a year of mid-caps.
Manish, what about cap goods? Of late, they as well have been showing us some trading moves. And if the assumption is that 2014 and we're going to see an economic growth, kicking back, definitely cap goods as well will do good.
So Aisha, that's more of a hope trade as of now. There are a lot of project announcements, but money is not moving on the ground. So, if you have a regime change at the center, obviously this entire hope trade will translate into execution and action. But I think the markets are not very confident about that aspect just yet. So, yes, stocks have run up, but there's nothing to suggest that things are changing at the ground level in a very significant way. So, I think post the elections, at the very least, the cap goods space should remain somewhat subdued. The numbers are nothing to suggest anything. Look at the IIP numbers. The cap goods space is still degrowing. On a low base, it's still degrowing. So Yeah, there have been a lot of policy announcements, but I think we have some more time as far as the capital goods space is concerned, and there will be enough time to get into the capital goods space, before you see any meaningful traction as far as the numbers and the earnings is concerned.
Manish, I haven't discussed politics. Markets are now slightly nervous about what the Aam Aadmi Party impact could be in the May 2014 election. If Aam Aadmi Party, if they end up getting 25-30 seat or 25-30 Lok Sabha seats, that really could spoil the entire market assumption.
Well, I don't know. I am not a great political expert or anything, but I think what you are saying is right. 25-30 seats here and there could be a game changer as far as the expectations of the market about a good government at the center is concerned. So let's see how the whole thing plays out, because they are contesting in 20 states and even one or two seats in each state, and they gather a total of 25, 30, 40 seats. That could make a big difference.
Manish, sometimes I wonder why are markets so excited about Narendra Modi coming back? Because if I look at the economic policies what BJP has followed, BJP also has supported Narega. They also have supported food security bill, and BJP has gone on record and they've indicated that, look, in principle, as a philosophy, we are against FDI and retail.
I don't know, market seems to be more confident about Mr. Modi as a Prime Minister in terms of the entire business community being having more confidence in that person. So yeah, they have supported socialist policies, but there's nothing wrong in that. But I think at least he can take decisions which has been the bane for the economy for the last 3-4 years. It's now only that things have started happening. So a person who can take decisions, and only time will tell whether those are right or wrong. And that is how business people want, and that is how the confidence comes into the business environment. So the entire last 3-4 years, business has been quite stagnant, and policy paralysis. People have been affected. So people have been expecting a change. Whether they get it or not, only time will tell. So let's see.
Okay, Manish, let you go on that note, and really appreciate you taking the time out and speaking with us today.